Well, a big story coming out in the terminal yesterday was what we heard from Stephen Roach, right, the former Morgan Stanley Asia chairman, revising his declaration that Hong Kong is over. He now says he's seen the city being reinvigorated by U.S.-China tensions. Now, that's something that Roach says he didn't expect when he wrote that column last year in the FT entitled, "It Pains Me to Say Hong Kong is Over." The city has seen a rush of funds into the stock market this year. I'm pleased to say that Stephen Roach joins us now live. Stephen, it's always great to have you. And obviously, we had you on the program a year ago when that column came out. Since then, maybe tell us kind of the timing of all of this and what's really changed in your view that maybe things might not be as bad as it looked.
Well, far be it from me, and thank you. It's good to be back again, Yvonne. I figured after I wrote that piece, you guys never wanted to talk to me again. But,
No.
and far be it from me to throw cold water on a great Bloomberg story, but the case that I made in the FT had three legs to the stool. My concerns over domestic governance, the tight linkages to a weak Chinese economy, and the notion that Hong Kong would get caught in the crossfire of the U.S.-China conflict. Those first 2 points, I'm afraid, are still very much intact. But the third point, getting caught in the crossfire, if I had to write the piece again, I would take the word caught out and say that Hong Kong is benefiting from the crossfire as more and more Chinese and other Asian companies are interested in listing in Hong Kong, and investors around the world, but especially in Asia, are embracing a sell America mindset for a variety of Trump-related anti-globalist reasons. And so the Hang Seng has really surprised on the upside. It's up 50% from, I think, early January. But, again, keep in mind, it's still down 25% from the early 2021 highs, but this is obviously a strong bounce, and who knows how much further it could go, especially given the negative political developments in the United States. If the U.S. Congress were to vote today, they'd vote to have all Chinese companies delisted from U.S. exchanges. And again, that probably would benefit Hong Kong.
Stephen, David here. I guess just to build on that, you mentioned three parts to the three legs to the stool. One obviously is to the point you're making now is benefiting Hong Kong. I'm curious how you're thinking about the other two right now. Do you keep an open mind that those two could change?
David, I keep an open mind that anything can change, and in my long career, I've certainly seen that. But I think the domestic governance issues are still a very disconcerting negative against Hong Kong. Since I wrote the piece 14, 15 months ago, more than half the foreign judges to Hong Kong's High Court of Appeals have resigned with some very direct critical comments about their concerns over the rule of law. And there's no shift, in my view, of the extremely tight linkage, the second leg of the stool, between the Hong Kong and Chinese economy. I note with interest that just got another report, I don't know, 24 hours ago, of the 14th consecutive monthly decline year over year in Hong Kong retail sales. Yeah. The growth risks to China, I still think, are worrisome, and the tight linkages between the two economies is unbelievable, and it's hard for me to imagine a spontaneous revival of the Hong Kong economy in a weak Chinese economic climate. So, I'm open. Show me the evidence, or give me a new consideration to factor in. But so far, those two are still working out pretty much as I had anticipated when I originally turned negative.
Stephen, I want to get your take more on that one leg that's working, right? The share raising, the IPO activity, and the quality of listings that are coming here in Hong Kong, right? It's very tech, very innovative companies that are coming here, and what maybe Hong Kong Exchange has been wanting. Is this a sign that at least Hong Kong is successful in acting as that financial capital between the East and West? And are there risks to that?
Well, I think it's certainly a testament to Hong Kong. Historically, Yvonne, has really been a thriving market for IPO activity in Asia. But you spoke as that role being a bridge to the East and the West. I would probably be a little bit more regional in naming the role. I think it's a bridge between China and the rest of the world's capital markets, who prefer to go through Hong Kong rather than a very inhospitable U.S. Capital market environment right now. I think, as the capital market climate in the U.S. Continues to be a very treacherous place for Chinese listings, Hong Kong is a major beneficiary of that trend.
Stephen, next week we'll be speaking with Paul Chan, the Financial Secretary of Hong Kong. And this is actually a question I plan to ask him. If his team is watching, here's the heads up, I guess. I think just to build on Yvonne's question there, right? So clearly it's a good thing that Hong Kong, its proximity to China, its position right now. And I'm wondering now what the disadvantages are of perhaps just the perception that Hong Kong is China's international finance center first and global international finance center second. If you could distinguish the two things, is there a difference between the two things? And do you think Hong Kong should more actively promote its non-China portfolio?
Well, look, I think Hong Kong can be a strong platform for Asian listings outside of China. There's no question about it. But the idea that Hong Kong can serve as a capital raising platform for Western companies, especially those in jurisdictions that are aligned with the United States, I think is a real stretch. I'm sure the financial secretary will speak eloquently of, again, Hong Kong as a global platform. But, if you look at the IPO activity to date and prospects of what's in the pipeline, I think it's very much dominated by China and Asian-centric companies.
Stephen, before we go, I kind of want to switch topics here on something that is also that's been very timely about what we've seen with President Trump and his calls to cut foreign student numbers at universities like Harvard. As someone that is a fellow at Yale, I'm just wondering your overall response to this.
Well, it's terrible. I mean, it's just, one of the worst things that I've ever seen a president do in my lifetime. I mean, one of the great attributes of the U.S. educational system, and I see this every day at Yale, is a thriving cross-cultural climate with students from all over the world. And, I've taught over the years large numbers of outstanding, intellectually curious, very smart Chinese students. And I would certainly hate to see that vanish from the scene. And I think it's a terrible thing that the Trump administration is doing in restricting that possibility in the future. And I hope it gets tossed out in the courts.
Stephen, let me take this specific issue, and then let's look at the broader sort of trade negotiation conversation. As you know, I think businesses are trying to figure out how to react to the present and plan for the future. And I wonder how you think about what's happening right now. Do you think these things will outlast the Trump administration? Is this something that you think will continue, whether that's what's happening in the academia or this sort of untangling between U.S. and China, to varying degrees, of course, in trade, but security perhaps most extreme? You know, what level of permanence do you see beyond the next 3.5 years?
Well, it's a great question. I mean, there are two aspects of the question that I would just focus on. One, the degree of policy uncertainty that is an outgrowth of a U.S. president who changes his mind multiple times a day. That is very Trump specific. And when he goes, I think we'll then go back to a more predictable policy climate. And uncertainty, of course, while it's going on, freezes the ability of businesses to make long-term planning decisions with respect to capital spending, hiring, and foreign sourcing. The second aspect, though, that's really probably more important is just to note that, you know, during Trump's first term, we were shocked with the tariffs that were put in place by President Trump in 2018 and 2019. But even more shocking was the fact that his successor, Joe Biden, kept those tariffs in place. And so post-Trump 2.0, given the very worrisome bipartisan anti-China sentiment in Washington, you know, it's quite conceivable that U.S. policy will remain tough on China for the foreseeable future.